Welcome back to Capital Forex Training. So in the next couple of videos we're going to be discussing a couple of patterns called the triangle and the wedge. So I think it's best if we split this into two. In the first video we'll go through exactly how to define or what defines these two patterns, so you know what you're looking for in your charts. And in the second video we're just going to go into our charts and show you exactly how to trade them. So the reason why we've chosen to use the triangle, or to discuss triangle and the wedge in the same video, is because the patterns look pretty much the same. But don't worry, we're going to go through every single one. But I think if we did separate videos for the wedge and the triangle, it would just be really repeating ourselves, as they're actually traded in exactly the same way as well. So if I can, so in terms of getting started, if I can just get your attention to the top left-hand corner here, where we've got the ascending triangle. Now this is a variation of a triangle. So in terms of characteristics, all you need to look for is a triangle that's got an ascending bottom trend line that goes in an upwards direction, and the horizontal trend line, or horizontal resistance line I should say, on the top part. Now you're looking for 2 hits minimum on each of those lines. So you've got hit 1 there, hit 2 there on the horizontal line, and in the ascending line, which is the line going upwards, hence why it's called an ascending triangle, you're looking for 2 hits as well, minimum. But bear in mind, you know, you can have 3 hits here or 4 hits in the bottom one. It doesn't really matter. But as long as you've got 2 hits each side minimum, that defines a triangle. So what you're looking for in terms of trading it is a break of that horizontal trend line. Because as you can see here, in terms of its characteristic, the market is trying to penetrate that line, failing once, bouncing back off the ascending trend line, failing twice, and then bouncing it back off the ascending trend line again. Oops, delete that. And finally penetrating through that line. So what you're looking for is a close above that trend line. Okay, you're looking for not just a break, but a close above that trend line. So the only other thing you need to do then is figure out your target, and that is simply the distance between, the distance from the last bounce on the ascending trend line to the horizontal resistance line. And you simply play this with a 1-to-1 risk-reward ratio. So the distance between the last bounce and the horizontal trend line is your target. So your target, you measure obviously what that is. Let's say it's 50 pips. And then you start measuring again from the horizontal trend line in an upwards direction. So and your target will be 50 pips. So I've just put X there and X there, which basically defines that the distance between the last bounce and the horizontal trend line is the same as your profit target, which starts from the horizontal trend line in an upwards direction, where you measure 50 pips. So in the descending triangle on the right hand side here, it's exactly the same, but the other way around. So you've got a horizontal trend line, a horizontal support line, which is the same, and the market has tried to penetrate that twice. So you've got penetration attempt 1 and then attempt 2, and you can see that the descending trend line is what defines this triangle. And you've got hit number 1, hit number 2, and hit number 3 there. And finally, obviously, after the third hit of the descending trend line, the market has penetrated that triangle past the support line. So you're looking for a close below it here. And all you need to do then is measure the distance from the last hit, from this point here to that point there. And obviously start measuring, say, let's say 50 pips again, for the sake of the argument that this is 50 pips. You measure 50 pips from the horizontal support line down in a downwards direction, because then X is the same as X here in this example. Then you've got a triangle. So I'm just going, it can take you to the bottom left-hand corner here. You've got just a basic triangle, and the reason why it's called a triangle is because both lines are going towards each other. It's not ascending or descending, or in fact, it's both. So the same, we've got the same here. Hit number 1 on the descending line, hit number 2 on it as well. On the ascending line, you've got hit number 1 and hit number 2. So realistically, it's just a integrated version of the top 2 that we were just discussing. And it's traded in exactly the same way. You're looking for a a close above one of the lines. Remember, this could be down here as well. If this failed and went in the downwards direction, then you'd be looking for a close here, but I'm just going to delete that for the sake of this example. So you're looking for a close there. You measure the distance between the last hit and that line there, the descending line, and you simply measure it from the same position in upwards direction. Let's say it's 50 pips, so your risk reward ratio is 1-to-1 again. And then lastly, we've got something called a wedge. Now the difference between a triangle and a wedge is that the wedge, the lines of the wedge are, even though the lines of the wedge are pointing in the same direction. So you can see in this situation they're both pointing downwards, whereas in the triangle you see one's pointing downwards and one's pointing upwards. Okay, that is literally the only difference, and it's traded in exactly the same way. So you are measuring the distance between the last hit on the bottom line to the close above the descending line in this example. So you're looking for a close there, and the distance X has to be the same as your profit target X in the upwards direction. And remember, it will be same, it was the other way around if you had a break below here, but obviously we're just going to use this as an example in this particular situation. And then you've got another wedge, but the only difference again is that this one is pointing in the upwards direction, but the lines look like they're going to close at some point. So it's very similar to a triangle, but both lines are pointing in the upwards direction. And again, for the last time, it's traded the same way. You measure, what you're looking for is a close below this line here. So you're looking for, in terms of your profit target, you're looking for the distance between the last hit and the point of penetration. So if that distance is X, you start measuring from the point of penetration in the downwards direction, so your profit target is X again. So remember, your profit targets are always 1-to-1 ratio, which means that they are exactly the same. So the amount that you would lose if you were wrong, it's exactly the same as the amount that you will get if you hit your profit target. So that's it in terms of defining these patterns. What we're going to do in the next video is go through how to trade them. So we'll see you then.